It's a green light for us still. You know us, investment managers, you've always got to throw in caveats, haven't you? But it is a green light, and we think the biggest driver is the fact that earnings yields compared to all interest rate expectations, be they cash or bonds, are still very favourable for equities. And what we find when we analyse that is that has a very good correlation with returns from equities 2 years hence. So there's a good relationship there. It is. We can't deny the fact that analysts have become a lot more optimistic, way more optimistic than where they were 6 months ago. The capitulation from analysts came in, way back in April. They stopped cutting forecasts. In fact, they're raising them now. So, things are priced in for next year. We have, expectations of certainly 20 to 30% improvement in earnings next year. So, outsized equity returns are less likely as a consequence of that because a fair amount is baked in. But we think that there is still an opportunity for good equity returns. As I said, that correlation for us works over 2 years. And that's the sort of time horizon we're talking about here. Anywhere from 6, 12 months out into 2 years, we think that equities are still your best bet.
As you know, over the course of the last 9 months or so, we've played this game of this basket is work from home, and it's all the stocks that have benefited from the reaction to the vaccine, to COVID and the pandemic and the lockdown. And over in this basket, we have all these cyclical stocks that have been beaten up as a consequence of the pandemic. As we move into 21 and we see the vaccine begin to be rolled out in different countries, how do you adjust your ownership of these two different baskets? Yeah,
it's absolutely key point when you get in under the bonnet of equity markets. It's one thing to say that equity markets have still got good potential, but what sections of it? What we saw over the summer after the initial broad-based rally of May and very early June, market leadership changed completely, and then for the next 2 or 3 months it was all about the tech leaders, the things which could benefit from COVID, and everything else went to sleep. And most recently we have seen that other basket of the reopening trade, as you call it, things tied to social mobility starting to participate once more. And I think that's going to continue. In fact, it has to continue, I would say, for this to be a solid, sustainable rally. Because it's one thing driving technology stocks, undoubtedly very strong business models, undoubtedly relatively immune to the effects of COVID. But it's one thing taking those businesses and driving them to ever higher valuations. But what we want to see is a broader earnings recovery, to our point earlier about what's going to happen in terms of meeting these forecasts, and that really is tied to these stocks. And those will be the things which will be the indicator, a confirmatory factor, actually, that the economy is on the mend. And it's not just about the effects of the stock market, it's also about what's going on in the commodities complex. I'm glad to say that actually the indicators there are also quite promising. The fact that the oil price is bubbling away, but actually, more importantly, and a little bit more advanced than that, seems to be the base metals. So these are the things which we build the economy with, and they are starting to improve, and we're starting to see some really quite interesting price action from commodities. So I would say, absolutely, it does have to be driven by different, broader sections of the market. Fortunately, the indications are at the moment pointing in that very direction.